What is an option contract? Option contracts are contracts, as you can see, between two parties. And so in this case, we have the buyer and then we have the seller. And whenever you have a contract, you always have something in the center. If it's a house, if it's a car, in this case, it's stocks at the center of this contract. And so when you have a contract between these two parties, you have to have what we call bullet points or clauses, shall we say. And I want to explain some of these considerations so that we can understand the true essence of a contract. Now, 3 things that every single option contract has in common. Number 1, it has an expiration date. Now, in every single contract, there's always going to be a time frame of which the buyer has the right to buy the stock from the seller, and the seller has the obligation to sell the stock to the buyer. In option contracts, we have some that last for 1 day, 1 week, 1 month, even as long as a couple of years. Now, we have names for all of that, but we won't go through that right now. Number 2, contracts have a monetary exchange. In other words, somebody will be paying money and somebody will be collecting money. If you ever bought a house or a car, there was money exchange, and so we call that a monetary exchange. Number 3, every single contract has a price at which the buyer has the right to own the stock and the seller has the obligation to sell that stock. We call that the strike price. I'm going to go into much greater detail a little bit later, but I want to make sure you understand some of these terminologies so they can begin to sink in your head. All right, let me give you an example here. So we have the seller. We're going to call her Brenda this time. And she owns a stock. She owns ABC stock. We're just going to give it a generic name, ABC stock. She owns it at $10. And she owns this, and along comes a buyer who says, hey, I want to buy your stock. George the buyer. And he believes that the stock is going to go up in price, and that's why he wants to buy the stock from her. So she owns the stock at $10, and he thinks it's going to go up to $30. Well, he decides to go enter into a contract with Brenda, and this is what we call the option contract. He signs that contract for the right to buy it at $20. That $20 price is what we like to call the strike price. So the strike price is the price at which Brenda is obligated to sell the stock to George, the buyer, at some date in the future. We have not clarified how long this contract will go on for. Could this contract be for 1 month? Will it be for 1 day, 1 year? We don't know. We also haven't talked about how much George is actually going to pay Brenda for this right to buy this stock from her in the future. But we're going to talk about that on the next slide. I just really want you to get the concept of what's happening here. Brenda owns a stock and George comes along and says, hey, I want to buy the stock from her. And so they enter a contract. Nothing's happened yet except for George has paid Brenda a price. We just don't know how much yet. Okay, let's try and put all this together so that it makes sense. We have Brenda the seller, and of course we have George the buyer. And what do we have between the two? Well, we recognize that George has already promised Brenda that he's willing to buy the stock from her at $20. She owns the stock at $10, as we stated in previous slides. And so what does this do for Brenda? Well, Brenda already has a buyer if the stock goes up. So we know in any business, you always have to have customers. Well, she already has a customer. And so that's a good thing for her. She already has somebody who's willing to buy the stock from her. So if the stock doesn't go up, no problem. But at least she already has a guaranteed buyer if it does. The second thing is that George is going to pay the monetary exchange that we talked about. George is going to pay Brenda $100 for this contract. So Brenda already has collected $100 on the stock that she owns. And that's the bonus. That's the bonus for her. So she's really loving this option. That's why she took on the risk. She doesn't mind getting rid of her shares at $20. She owns it at $10. She gets out at $20. That's a $10 profit. So she made $100 on top of the $10 profit if the stock goes up. Now, granted, the stock might go to 20 or 30 or 40, like what George thinks. And that's why he's willing to take on this. That's why he's willing to pay for this. But what happens if it doesn't go to 30? Well, for her, that's a good thing because she still collected $100 just for owning some stocks. And so now we need to talk about how long is this option contract for? Well, I think we're going to say it's going to be for 90 days. Let's just say we're going to say 90 days. So in 90 days, George has the right to exercise to buy the stock if it goes above $20. He doesn't have to buy the stock from her. But what he is saying is, I'm willing to buy from the stock from you at some point in the future if it goes above $20. And so this $20 level, we call the strike price, is really where he starts to see, can he make money? Now, there's more that goes into it, but this is just the basics of what we're talking about. So the last thing we haven't talked about is the fact that, why would George do this? Well, for George, he is only going to put up $100. And so what we haven't talked about is the fact that every single option contract actually represents 100 shares of stock. And so if we were talking about actually buying 100 shares of a stock that costs $20, that's $2,000 that George will have to put up. Well, George doesn't have to risk $2,000. He can put up a fraction of that, $100, and still control $2,000 worth of stock. And so that is the bonus for George. He doesn't have to put up a lot of money, but he still has the right to buy. He still controls $2,000 worth of stock. So he can still benefit from the stock going up, even though he didn't put. And so we call that leverage in this case. And so it's a win-win situation. Brenda makes money. She has a guaranteed seller. George saves money as far as money invested, but still has the right or the possibility of owning the stock and making money. Let me summarize the most important parts of this option contract. Number one, each contract represents 100 shares of stock. And so when you go to your brokerage account, and a brokerage account is just like any other bank account, Chase or Wells Fargo, it's just another place that you deposit money. But instead of collecting the money back, you're allowed to buy stocks and certificates. And so that's what makes it different. Well, when you go to the brokerage account, you'll see a list of prices, and it might say $1.50 or $2. And you have to take that and actually multiply it by 100. So $1.50 would actually be $150. That is the actual cost of the options contract. Number two, there are two parties to each and every contract, the buyer and the seller. Now, a lot of times we believe that it's one-to-one. So if Brenda sold to George, well, then it's just Brenda and George having a transaction. That is not true. There are thousands of buyers and sellers inside the market. And so when you buy a contract, you don't know who you're buying or selling to. And so you have to really worry about the terms and conditions of the contract, right? Did the stock pass your strike price? Because in that case, the buyer of that option probably will say, hey, I want to buy it from you, because now they can make money, right? If the stock did not pass your strike price, then they probably won't, because why would they actually buy it from you for 20 when they can go to the open market and buy it for 15 or something like that? And so we have to look at that aspect of it. You have market makers, and that's the people that actually create the contracts for the thousands of buyers that are actually in the market. And number three, there's a strike price, which is established at the beginning of the contract. We talked about this in our lesson so far. In our case, the strike price was $20. So as the buyer of that option, you want the stock to begin to get above $20. And that's when you can begin making money as the buyer of the option. And last but not least, number four, every single contract has an expiration. And so we talked about it could be 1 day, 1 week, 1 month, a couple of years. And so you establish all that. And just like anything in life, if you have a longer expiration, you have more time for this contract, you're usually going to pay more money. So if you have a shorter time, then you're usually going to pay less money. And so these are the basics of the option contract.